Hey, welcome to Mr. Market. Thank you so much for joining me. We're now into episode 21. For this past week, we had some big economic news. We had CPI coming in at expectations and PPI coming in a little bit below expectations. And initially, the market rallied on that news, but eventually just gave it all up again. You know, this whole inflation narrative is pretty much being priced into the market. The market really doesn't seem to care anymore that inflation is starting to come down. We've had these numbers kind of come around expectations for the past few months, and it's kind of an old story. Now the market's just looking forward to the coming xdate, which Treasury Secretary Janet Yellen has said is expected to be as early as June 1st. So the market's starting to get a little bit more nervous as we get closer to that date. So for the second week in a row, the market was down. This time it was down about 0.25%. And for us, we continued to go make money. We were up $1,150 for this past week, and year to date that puts us up $29,980, which puts us just a little bit under 60% of our annual goal of $50,000 a year. Again, as a reminder, we are aiming to make 20% a year with our strategy, and we are nicely ahead of schedule. Okay, let's talk about the market and let's look at some charts. First, let's take a look at the big picture. As you can see here, we have the market, it was in a wedge pattern where you have the rallies being sold, but the dips are getting bought. And then near the end of it, it started to try to break out a little bit above it. It's a very weak move. It was almost as if someone was trying really hard to keep that chart right above that downtrend line. Over the past week, on 4 out of the 5 days, the market dipped. But about a couple hours before the close, we ended up getting a rally. And it was kind of like a bad horror movie villain, you know, where you think it's dead, but then it just keeps coming back. And kind of that's how the market is.
So if we zoom out a little bit and analyze the volume, we can see that the rallies are actually getting weaker and weaker. And in fact, that uptrend we've had since early March is broken. Now this chart here also tracks the behavior of the buying and the selling relative to its volume. And if you look at that indicator on the bottom, when this line is above the zero line, that means the market is in a healthier uptrend and dips tend to get bought. But when the line is below the zero level, like it is right now, when you have rallies, it tends to get sold. And so that puts the market in a more vulnerable state. Now that's probably not a coincidence that we're now entering the 2-week period before the xdate. And if history is any guide, back in 2011, that 2-week period was the beginning point for the market's decline as we got closer to the deadline. So a lot is going to depend on how these negotiations turn out over the next few weeks. As a sign of how nervous the market is, at least for the bond market, you can take a look at the Treasury bill yield curve. And you can see here that yields spike right at the beginning of June, because that's where the market is expecting the government to potentially default on its debt. JP Morgan's been taking this pretty seriously, so much so that they put together a war room that meets once a week to go talk about this. And then around May 21st, instead of once a week, they'll be shifting to daily meetings. And then after that, they'll be shifting to 3 meetings a day. Which brings me to the main point of this episode. So the other day, I finished reading a great book about poker and psychology, which I thought was interesting because poker has so many similarities to trading and investing. The book is called The Biggest Bluff, written by a Russian-American PhD in psychology named Maria Konnikova, who knew absolutely nothing about poker and asked to be mentored by Eric Seidel, a poker legend who has won 9 World Series of poker bracelets. He agreed, and over the course of a year, she combined her knowledge about behavioral psychology and what she learned from Eric Seidel to win a national tournament. Now, one of the things she learned along the way was a side game that happened during these poker tournaments called Lodden Thinks, which was created by 2 poker pros who knew a guy named Johnny Lodden. They would ask Lodden a question that had a numerical answer, and the 2 would bet on what Lodden would think the answer was. That's how the name Lodden Thinks got its name. So the important part here is that actually knowing the correct answer meant very little to your success. What mattered was what Lodden thought was the answer, and it didn't matter whether his answer was the right or wrong answer. You just needed to be aligned with his psychology to win. And that's what I realized the stock market was like. You can have the perfect mathematical model, but it'll often be wrong because the human element always gets in the way of the mathematical model. And stock markets are driven by human perceptions and emotions. And so a couple years ago, I came up with a saying that pretty much captured the same idea. It's not my opinion of the market that matters. It's my opinion of the market's opinion that matters. And that's when my trading results improved. That's because you can have a worldview, and if you hold on to it too tightly while the market is moving in a different direction, you can lose out and get hurt fighting the market. And the market is always right, which is why a system that helps you follow the trend, despite your worldview, is one of the biggest keys to success in the market. So you may know the correct answer to how old Brad Pitt is, but in the stock market world, if they guess that he's 57, the answer that's closest to the market's guess wins. And it doesn't matter that Brad Pitt is actually 59. So, to tie it all back to today's stock market environment, I may have the worldview that the market will fall heading into the xdate, but if the market doesn't and instead starts to move up, then that's a situation where the Lodden is guessing at a different answer, and it's his answer that'll determine my success, because maybe the xdate will get pushed out further, or a deal is getting closer to being made and we just don't know about it. But the market has more information than I do, and insiders often act on news before it's made public. But we can see it unfold in the charts, so it's important that I at least respect the trend and adapt to it. So for this week, I sold some puts on the S&P 500 ETF of $400, $398, and $395. Plus, I sold some calls up at $420. Now the algo is still mildly bullish, but the triggers for it going negative are pretty close to getting hit. So the bullish signal is pretty fragile, and as we get closer to June 1st, I'm imagining that it could turn negative.
So that's what I'm seeing in the market for this week. I hope that helped you get a little bit more perspective and hopefully improve your trading for the coming week. And if you haven't yet, please click like and subscribe so then you'll know when my next videos drop. You can also find me on my new domains, mistermarket.us and mistermarket.us. So thanks so much for joining me, and I will see you next week.